In 2025, more than 300,000 people left California, not for vacation, not for work trips. They packed everything they owned and moved somewhere else permanently, chasing lower taxes, cheaper housing, and a financial situation that actually made sense. And in 2026, that number is not slowing down. The headlines say California's housing market is stabilizing, soft landing, gradual correction, nothing to worry about. But when you look at what is actually happening, insurance premiums up 20% in a single year, listings sitting unsold for 60 and 70 days. Families spending 45 and 50% of their income just on housing, the story looks very different from the one being told. This is part of our Collapse series where we break down the economic shifts most people don't see coming until it's too late. Today, we are going through the 10 California cities where the warning signs are loudest in 2026, not because everything is about to crash overnight, but because the slow grinding correction that is already underway could quietly drain your savings, your equity, and your financial stability for years if you buy in the wrong place at the wrong time. By the end of this video, you will know exactly which cities to avoid and why the math no longer works in them. Number 10, Los Angeles. Behind the movie lights and palm-lined streets, Los Angeles is entering 2026 under a level of financial pressure that its glossy image struggles to hide. The median home price sits around $860,000, while the median household income barely reaches $78,000. That gap is not a rounding error. It means that for most working families in this city, the front door to homeownership is simply closed. A typical monthly mortgage in Los Angeles now exceeds $4,000, and that is before insurance, property taxes, or HOA fees are added. Insurance premiums have doubled since 2022, driven by worsening wildfire exposure and heat-related claims across the region. In the first quarter of 2026, nearly 25% of homes dropped their asking price. Even in desirable neighborhoods like Silver Lake, Echo Park, and West Hollywood, listings are sitting longer and price cuts are becoming routine. More than 30,000 residents have left Los Angeles since 2023. Teachers, nurses, artists, and service workers who built the city's culture and kept it functioning. They are leaving because the math stopped working for them. For a city built entirely on the idea of making dreams possible, home ownership has become its most persistent illusion. Number 9, Oakland. Oakland once offered something rare in the Bay Area, a city with real culture, real diversity, and prices that were at least somewhat within reach compared to San Francisco across the water. That window has closed. The median home price now stands at roughly $710,000, while the median household income barely touches $82,000. More than 30% of listings in early 2026 saw price cuts. Homes are sitting unsold for an average of 65 days, more than double the pace of just 2 years ago. But the deeper problem is not price, it is confidence. Oakland now ranks among the top 5 cities in America for property crime. Car thefts, break-ins, and assaults have driven both residents and small investors toward the exits. Since 2024, more than 11,000 people have left the city, taking their tax dollars, their businesses, and their long-term investment with them. Insurance costs in hillside neighborhoods have climbed nearly 40%, and many homeowners are being dropped from coverage entirely left exposed to wildfire risk with no safety net. Oakland still has something real: the murals, the music, the community resilience that no price decline can erase, but soul alone cannot sustain a housing market. The buyers are wary, the foundation feels unstable, and the direction of travel is difficult to ignore. Number 8, Stockton. Stockton has spent years rebuilding its reputation after becoming a symbol of the 2008 financial crisis. That recovery was real and hard-won. But in 2026, the cracks are widening again, and this time the warning signs are too consistent to dismiss. The median home price hovers near $475,000, while the average household income struggles to reach $68,000. Families who stretched to buy during the pandemic price surge are now dealing with adjustable rate resets, inflated insurance costs, and equity that has stopped growing. Foreclosures are up 15% year over year. Nearly 1 in 4 listings slashed their asking price in the first quarter of 2026. Homes are sitting unsold for 50 or more days, a sharp contrast to the bidding wars and cash offers that defined this market just a few years ago. Violent crime remains persistently high, eroding buyer confidence and pushing investors towards safer markets. New construction continues to expand on the city's outskirts, but demand is not keeping pace. Empty houses are accumulating faster than occupied ones. What is happening in Stockton is not a dramatic collapse. It is a gradual squeeze on working families, on confidence, on the sense that things are moving in the right direction. And in real estate, gradual and persistent is often more damaging than sudden. Number 7, San Diego. San Diego is one of the most visually compelling cities in the United States. Ocean breezes, year-round sunshine, a food scene that punches above its weight. It is the kind of place that makes the price feel worth it, right up until you run the actual numbers. The median home price has climbed back above $840,000, while the median household income sits around $85,000. That imbalance forces many homeowners to spend more than 45% of their total income on housing alone before insurance or property taxes are even added. And insurance has become San Diego's quiet crisis. Wildfire exposure on the eastern edges, coastal erosion along the shoreline, and rising sea levels have driven premiums up nearly 60% since 2020. Some insurers have pulled out of the market entirely, leaving homeowners competing for limited high-cost coverage options that did not exist as a category 5 years ago. The once booming downtown condo market is cooling. Developers overbuilt during the demand surge, and now more than 1 in 4 listings saw price cuts in early 2026. San Diego still looks like paradise from the outside, but behind the postcard view lies one of the most financially strained housing markets in the state. The lifestyle premium that made this city feel worth any cost has quietly become a liability, a beautiful trap for anyone who buys at the wrong moment in this cycle. Number 6. Burbank. Burbank built its identity around proximity to power the studios, the sound stages, the creative infrastructure of Hollywood. For decades, that proximity translated into a stable, desirable housing market that held its value through cycles that hit other cities harder. But in 2026, that insulation is thinning. The median home price has climbed near $970,000, while the average household income sits around $92,000. Interest rates above 6.5% and property taxes among the highest in Los Angeles County make ownership here genuinely punishing at current prices. Insurance has become a serious and growing cost. Wildfire exposure from the Verdugo Mountains, record heat events, and multi-year drought conditions have pushed average annual coverage costs above $4,700 for basic protection. Many longtime residents are now spending close to half their take-home income on housing-related expenses before anything else is budgeted. The entertainment industry's post-strike contraction has added another layer of pressure. Layoffs in animation, production, and adjacent tech roles are rippling through the local economy and reducing the buyer pool that once kept this market moving. Homes that once generated competing offers within days are now sitting for 2 months or longer before a serious buyer appears. Burbank still looks the part: tree-lined streets, classic diners, the familiar glow of studio infrastructure. But beneath that surface, buyers are hesitant, sellers are under pressure, and the market has the unsettling quality of a production set where the filming has stopped. Number 5. Santa Cruz. Santa Cruz has always carried a specific kind of appeal: the redwoods meeting the ocean, a bohemian energy that felt genuinely different from the rest of the state. For buyers who wanted California's natural beauty without the corporate density of the Bay Area, it felt like a discovery. In 2026, that discovery comes with a price that has moved well beyond what most households can realistically sustain. The median home price now sits at approximately $1.18 million, while the average household income barely clears $87,000. That ratio makes Santa Cruz one of the least affordable housing markets in the entire United States. Climate risk has become Santa Cruz's defining financial pressure. The city faces a compounding set of threats: coastal flooding, sea level rise along the shoreline, and wildfire exposure in the surrounding hills. Insurance premiums have surged 45% since 2022, with some properties now requiring specialized coverage that costs thousands per year. Certain coastal policies are being denied outright, leaving buyers to absorb risk that used to be transferable. In the first quarter of 2026, nearly 27% of listings saw price reductions. Homes are lingering on the market at roughly twice the pace of the pre-pandemic period. Younger families are leaving for inland counties where the same dollar stretches further and the climate risk profile is less complicated. Retirees and outside investors are hesitating at a price point that requires enormous capital for a market that feels increasingly fragile. Santa Cruz still has that pull: the boardwalk, the surf, the light on the water at dusk. But the cost of experiencing that life has crossed into territory that is, for most buyers, financially difficult to justify. Number 4. Santa Barbara. Santa Barbara occupies a specific position in the California imagination's Spanish colonial architecture, a Mediterranean coastline, a pace of life that implies ease and permanence. It has long been a market for buyers who could afford to pay for perfection. In 2026, even that buyer profile is hesitating. The median home price now approaches $1.45 million, while the average household income sits around $93,000. The average monthly mortgage has ballooned beyond $5,000, and that figure does not include property taxes, which rank among the steepest in the state. The environmental pressure in Santa Barbara is significant and multi-directional. Wildfire risk from the foothills, mudslides during heavy winter rains, and persistent drought conditions have made insurance increasingly difficult to secure and afford. Annual premiums now top $5,200, and some hillside properties can no longer qualify for standard coverage at any price. In the first quarter of 2026, nearly 30% of listings cut their asking price, and average time on market has stretched past 70 days, a meaningful signal that even the upper end of the buyer pool is pulling back. Since 2024, more than 8,000 residents have left Santa Barbara. Not the wealthy buyers who own second homes here, but the service workers, teachers, and small business operators who make the city function daily. As that workforce disappears, local businesses are struggling to stay staffed and open. Santa Barbara still photographs like a dream, but behind every perfect sunset, a market is quietly tilting toward imbalance. Number 3. Palm Springs. Palm Springs built its brand on a specific promise: desert, luxury, mid-century design, and the kind of leisure that looks effortless from the outside. Old Hollywood came here to escape. Designers came here to be photographed, the image held for decades. In 2026, that image is intact. The financial reality underneath it is not. The median home price sits around $670,000, while the median household income barely reaches $72,000. That gap is being compressed further by utility costs that have become a serious monthly burden last year. Palm Springs recorded more than 70 days above 110 degrees Fahrenheit, and air conditioning now consumes a meaningful share of household budgets that buyers rarely account for during purchase decisions. Insurance premiums in high-risk zones have climbed 55% since 2023. Some carriers have withdrawn from the Palm Springs market entirely, leaving homeowners on expensive state-backed plans or uninsured. The short-term rental boom that drove a construction surge has left the market saturated. Nearly 1 in 3 listings cut their prices in early 2026. The paradox is visible in the data: plenty of available homes, not enough willing buyers, and a growing gap between what sellers expect and what the market will support. Palm Springs is still iconic. The pools still shimmer, the mountain backdrop still delivers. But the desert sun that built this city's reputation is now the same force, making it increasingly expensive and increasingly risky to own property here long-term. Number 2. Mendocino. Mendocino sits on the edge of Northern California in a way that feels almost separate from the rest of the state. Rugged coastline, redwood forests, a pace of life that genuinely slows down. For buyers seeking escape from California's density and noise, it has always carried an appeal that is hard to quantify in financial terms. In 2026, the financial reality is the part that needs examining. The average home price sits above $655,000, while the median household income barely reaches $62,000. That imbalance has priced out most local workers and pushed families to relocate inland, leaving behind a shrinking, aging population and a housing market that is slowly losing its transactional foundation. Insurance costs are climbing steadily, wildfire exposure across forested zones, and storm damage risk along the coast have pushed average annual premiums to approximately $4,900. Some carriers have stopped writing new policies in the area entirely, directing buyers toward expensive state-backed alternatives. Infrastructure is a compounding problem that receives less attention than the market data, but matters just as much to anyone considering a purchase. Roads deteriorate during winter rains. Power outages are routine. Broadband remains unreliable across significant portions of the county. Access to healthcare and essential services is limited in ways that create real, practical constraints for full-time residents. In the first quarter of 2026, 35% of listings saw price reductions, the highest rate anywhere in Northern California. Mendocino is still breathtaking in the way that genuinely remote, genuinely beautiful places are. But beauty does not stabilize a tax base, and tranquility does not offset structural decline. This market is not collapsing dramatically. It is eroding one family, one insurer, one empty house at a time. Number 1. San Francisco. San Francisco is where the California housing story reaches its most complex and revealing point. The city that defined the modern tech economy, that attracted global talent and global capital, that made the Golden Gate the most recognizable urban image in the world. In 2026, that identity is still present, but it has been significantly hollowed out. The median home price hovers around $1.3 million. The median household income stands near $125,000 higher than almost any other city on this list, and yet the math still does not work. Insurance premiums now top $6,000 per year. HOA fees for condos routinely exceed $2,000 per month. Property taxes on a $1.3 million purchase create an annual obligation that layers on top of a mortgage that already stretches most buyers to their limit. The population shift has been substantial and sustained. Since 2021, more than 60,000 residents have left San Francisco. Tech professionals, families, long-term residents who decided the trade-off no longer made sense. Downtown vacancy rates remain above 30%. In early 2026, nearly 1 in 3 homes listed for sale saw a price cut. Even the luxury segment, which historically moved independently of broader market pressure, is now sitting longer than it used to. Crime and safety concerns in commercial corridors have discouraged small business investment and complicated the buying decision for households who might otherwise absorb the price. San Francisco has not lost its identity. The creativity, the architecture, the views, the density of ambition that made it extraordinary, that is still present. But the city has been restructured by cost and consequence in ways that are not temporary. What is left is a market carrying enormous prestige and enormous financial weight simultaneously. For buyers with deep capital and long time horizons, there are selective opportunities. For most people evaluating a purchase decision in 2026, the risk-to-reward ratio does not support the price. Conclusion: 10 cities, 10 variations of the same underlying story. California's housing correction in 2026 is not a crash. Prices have not collapsed. The headlines are not wrong when they describe stabilization. But stabilization at prices this high, with insurance this expensive, with inventory accumulating and buyers pulling back, that is not the same as health. It is pressure that has not yet released. 3 forces are driving this simultaneously. Interest rates remain high enough to make affordability genuinely painful, even where prices have plateaued. Insurance and property taxes are rising faster than income, particularly in coastal and wildfire-exposed markets. And inventory is quietly building more sellers, fewer qualified buyers, and a growing awareness that the peak of this cycle may already be behind us. But the picture is not uniformly negative. Patient buyers in a correcting market have options that did not exist 2 years ago. As overvalued California cities adjust, markets in the Inland Empire, parts of Nevada, and other lower-cost western states are beginning to offer value that the numbers actually support. The shift happening across California is not the end of the state's appeal. It is a repricing of what that appeal is worth, and a reminder that in real estate, timing is not everything, but it is a great deal more than most buyers admit when they fall in love with a place. Which city on this list surprised you most? Drop it in the comments below.